Alright, y'all, good morning. I think the next topic I'm going to be talking about in part 2 of this bootcamp is going to be liquidity and the meaning behind it, I guess, and how I use it, what's my approach behind it, how do I mark it out, how do I find it, and yeah, let's get into it. Alright, guys, before I get into it, I just want to tell you guys what liquidity is. It's basically where points in the market where we think contracts are lying. For example, if I were to, where am I? If, for example, today Monday opened right here, what would I mark out? I would mark out this level. Why? Because hey, price came down here and rejected back up, meaning anyone in this previous session, aka London session / Asia session, they would most likely put their stop loss here if they were trying to seek higher. Therefore, being that we know that there are contracts there and stop losses there, banks are going to come down and stop those people out. Why? Because once they are stopped out, there's more contracts for banks to buy up before they make the big move. Being that banks actually need fills of contracts, they need to actually stop people out before they can actually fill every single contract they have because they're trading in such volume. With that being said, we as retail traders notice those levels, it comes down ticket, and we trade the reaction of it. Being if we hold above this sweep right here, I'm holding a bullish bias because banks are satisfied with the amount of contracts they got and they're ready to make their leg up to the next pool's liquidity, wherever that be, which we'll find later. And vice versa, if we hold below that level, it means banks are not satisfied and they're going to continue searching, whether it be down here. In this case, it didn't happen, but this could potentially happen. Price just ignores this level, takes the contracts there, and goes lower to take these levels. We just are trying to determine where banks will be satisfied with the amount of contracts they get filled before they make the move in the opposite direction. Because obviously they want to buy at the cheapest price or short at the highest price before they execute. And yeah, that's the general idea of liquidity itself. And now I'll go into how to find it. Alright guys, let's get into this. My 4 main pools of liquidity. This is probably the ranking, I'll put them in as well. Starting off with previous session highs and lows, such as Asia and London session. Then I'll jump to fair value gaps as my next pool of liquidity that I use majority of the time. Data highs and lows are very valuable, but they don't come every single day or every single week sometimes. So I kind of put them lower on the tier list, even though they are severely stronger than fair value gaps of previous session highs. And lastly, low resistance liquidity is just little pools of liquidity. Jumping into the first example of my favorite, which is previous session highs and lows, because you can see, I'll give you guys an example of literally yesterday, Friday. Price came down over here. Market opened at 6:30 right here. Price came down straight into our London low, and as you can tell, it just pumped up 245 points, and that's how we determine our bias. As long as price came down here, it took out this level and held above it. I was looking for a bullish bias the entire day until we took out either London high or previous Asia session high, because that's just how banks move. They move towards pools of liquidity in order to fill their contracts. They want to buy and sell at the highest price possible. Now, in regards to why these pools are so strong, is because if you were to enter any long position or short position, any long position within this leg of London, well, maybe I'll target Asia high. I don't know. I don't really trade it, but I know that stop loss is most likely going to sit at the London low. Hence, there's going to be a lot of contracts there for banks to satisfy themselves if they were to seek out that level and want to see higher. Therefore, in this case, it happened. We came down, took it, and we saw higher. That's how I determine my bias via liquidity pools of previous session highs and lows. Alright, y'all, going into the next one. Let me full screen this shit. Number 2 would be fair value gaps. As you guys can tell, price was extremely bearish here, and not every single contract got filled because of how fast it was selling off. As a result, if we mark out the gaps between, which we would call fair value gaps, we would know that contracts are lying in between. If price comes into it and rejects off of it, we know that sellers are still present, and we can hold our bearish bias in this case because, well, just like previous session highs and lows, there's contracts lying in within these gaps. And once we see a reaction off it, we can trade with it. Another example of this would be on my Discord. Although we missed the initial move over here of this gap where we could have just seen full TP right away, we caught the second move. Price came down and we tapped into this imbalance of price where buyers were sitting. Being that we respected it and we pushed back up, buyers were able to push the market back up and follow bullish order flow. Higher high, higher low, higher high. It gave me confidence that price was going to see higher into our objective, which was previous days Asia highs. As a result, which was in a liquidity pool, by the way. Yeah, it's just the same concept, except for it's a gap in the market. They both are previous session highs and fair value gaps are both points where we know that contracts are sitting, and if banks react off of it, we can use that reaction to determine our bias slash trade for the day. And yeah, sounds good. Alright guys, hopping into the last two sections, which I'm just gonna vaguely go over. Data highs is just news candles. At 5:30 last Friday, we had a news candle at 5:30 a.m. CPI, 5:30 a.m. CPI. I'm gonna mark this out as, it also lines up as my London high, but this would, I'll mark this out as my data high. Price would come up, sweep up my London high as well as my data high, and we would see a 75-point sell-off, which, let me put on my candle. Yeah, more than a 75-point sell-off. We saw a 166-point sell-off. It's just another pool of liquidity we can play off. It's just this same reaction as previous session highs and lows. So if we hold below it or high below it, we look for shorts. Or we hold above it, banks are satisfied, we're looking for higher, bearish, bullish. And then yeah, let's go into LR as well, because they're basically the same thing. Or not the same thing, but they're pretty easy to explain. Concepts of, we can see LR here. There's like easy points, like swings in the markets, random swings in the market that don't really have significant pools, but they are still considered pools of liquidity because contracts are still laying here, because potentially within, not everyone's going to put their stop loss at the Asia high. Maybe they'll put it at this leg because they think it's a protected leg, or here, or even here. So it's just little pools of liquidity where market has a chance of reversing, but it's very, very much smaller and most likely just going to be a pullback compared to as if we took out Asia high or previous session high or low, it would be higher chance of reversal. And yeah, usually I use these as my price targets for trims. I'll trim off some contracts at maybe this internal high, and then this internal high, and then full TP at Asia high, something like that. And yeah, that sums it all up. Alright guys, long story short, I trade the reaction off liquidity pools. But we take out the London high as we did right here, and we held above it. The candle made a closed above it, then I'll wait for my reaction. Sorry, I'll look for longs until we took out the next level. Why is it so big? Until either here or up here, or even into this 15-minute gap, until we see some sort of reaction to the downside. Once we start holding below it, like the case right here, I can confirm my bearish bias. As long as we hold below this level, I'm looking for shorts. If we hold above it, I'm looking for longs. That's how I determine my bias. Hold below the level, look for shorts. Hold above the level. I just trade the reaction of the level itself. Another example would be down here. We took out the London low, and therefore, or because we held above it, I had a bearish bias until we took out the next level. If we were to not be satisfied and not going to reverse, I would look for a continuation model, which would be shorts. As long as we hold below this level, I would have a bearish bias, and I'll target the next level, which will be down here, wherever this is, somewhere over there. And yeah, I gauge my bias off the most recent liquidity sweep. Whether it be shorts or longs, you just determine how we hold it above it or below it. And yeah, that sums up everything. Goodbye.